Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 14th of August. I'm Daniel Lam, your host for the podcast. So we now have the newest set of non-farm payroll and CPI figures in the US. In order to fully understand how they would influence risky assets, we must look at the positioning of US equities. Now, broad US equity positioning is neutral, but under the surface, there are divergences on the sector level, and not all the sectors are well placed for weaker US data. Now, in a nutshell, the banks may experience consolidation if data were to be weaker, while staples would benefit. So let's look at the market reaction in last August, following the non-farm payroll jobs miss, which was different from this year. So last year, the S&P 500 dropped 1.8% and then continued to fall further in the following sessions. Now this year, we saw the S&P 500 decline by 1.6% on non-farm payroll day, but after the knee-jerk sell-off, the S&P 500 has already recovered. Now the divergent reaction between these scenarios is not due to the magnitude of the NFP misses either. They were broadly the same. Now both prints missed expectations by 160 to 180,000 inclusive of negative revisions to the prior month. Instead, the key difference between the two periods was equity positioning. Now a year ago, positioning was undeniably more stretched heading into the NFP print than this time around. And at just 0.35 standard deviation above average, this neutral US equity positioning will limit significant downside risk. At times like these, falling back on US technology tends to be a common default strategy. So the US economy is in stall speed, but the tech sector, and particularly the mega caps, they continue to deliver strong earnings growth. In fact, during this earnings season, beats across the growth segments of the market have returned better than in the last few years. So this would indicate that positioning is not excessive in technology sector. More specifically, the positioning in semiconductors is well off the extreme highs of early to mid 2024. Trump's threat of 100% tariffs on semiconductors would appear to be a worry on the face of this, but the point is that exemptions will apply for those investing in the US. What else? Well, the US staple sector is not crowded, making this a good hedge for downside macro. Now, when the key US data has disappointed in recent months, the US staples have been a consistent outperformer versus the overall markets, but only when positioning has not been crowded. So we can expect volatility ahead in US equities in the overcrowded positions in a few key areas. And in the spirit of diversification, investors may consider trimming down excessive long positions in the more overcrowded sectors, such as financials and industrials, and rotating into the less crowded sectors aforementioned, add to gold on pullbacks, and bonds of 5 to 7 years of duration. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.